Hello everyone, it is November 20th, 2018, and as I'm recording this, the stock market is down a little over 500 points, and this is actually coming off the backs of a nearly 400 point decline yesterday in the Dow Jones Industrial Average. And it's also important to keep in mind that when you say, trying to compare this apples to apples, that what the Dow Jones does is periodically they start kicking off the people that are underperforming. So GE used to be on there, and Bank of America, and pretty much I think all of the original stocks that were on the Dow Jones, GE being the last one, are now no longer part of it. So it's definitely a cherry-picked number that they have. But in any regards, even their own cherry-picked numbers are down pretty substantially. So this is one thing to keep in mind. And for those of you who have not seen episode 36, I would highly recommend going back and watching this. And actually, I'd recommend watching 37 and 38 as well. Have another video that's only about 8 minutes long called "The Perfect Financial Storm is Brewing," and then another one that's called, I think it's "Government Odds of Financial Success Are Zero." Highly recommend going and checking all those out. Also, as a quick housekeeping note, if you guys could actually go on iTunes or all the different places that this podcast is hosted, primarily iTunes, that's where a lot of people are watching, or even on YouTube, if you go and actually rate us 5 stars, maybe give us a quick little review. And if you're not a client already, consider having a conversation with myself. We do have investment portfolios that are highly scalable, that are customized to you, where what we're doing is we are investing into put options, where the put options are counteracting the market when it goes down. So what I should state, rather kind of going back a few seconds, is we have invest a small amount of the portfolio into put options. So essentially what it's doing is it's sort of like buying homeowners insurance. If you hope you never need it, but let's say you live in California and you have a wildfire and all of a sudden your house burns down, you've got the insurance to build it back. I guess that's a whole different story, whether or not those people would want to build back in that type of area, or if their insurance rates would increase or not, which who knows, maybe that helps out the GDP, having to build back all these houses. But in any event, most years your house is not going to burn down, and so you pay the insurance, and in the event that your house does burn down, then we build it back. Same principle with the stock market. And so that's why our clients have seen, relatively to everybody else, have done pretty well during this last period, because we did take a small amount of their portfolios to invest into put options. So if you could either maybe share, I think episode 36 is probably the best one, just because it was made actually before the stock market goes down, or before it started going down. I mean, anybody can act like Jim Cramer, who after several of the horses have already left the barn, start warning about the barn door being open. But this information is information you don't really see anywhere else. Actually, I guess before 6 weeks ago, you weren't seeing it anywhere else. And now you're even seeing people like Jim Cramer, who are starting to sound a lot like Tim Picciott, which should be relatively concerning.
Dallas Kaplan asked the right questions. I want prudence. I favor a rate hike, and then I'd like to wait. In what world is that is that irrational? In what world is that considered to be imprudent? They are doing things that are frankly not safe, and they are saying things that are frankly irresponsible, and they need to be called on the carpet. I am not some TV guy who is a 63-year-old person who just woke up. I was born at night, but not last night. And I'm just saying, you know what? Come on. Focus, guys. Just because you're on the Fed doesn't mean you stop work.
Yeah, and here you go. He is not just some TV entertainer. Just as much as I'm not a 32-year-old financial advisor into cryptocurrency and does triathlons. And now here's another quick clip from Jim Cramer where he starts ringing the alarm bells again.
11 years ago, I began to hear the same kind of talk about how the Fed seemed to be out of sync with what was happening, this time with Wall Street. My sources were so darn good back then. I was part of the diaspora of Goldman Sachs alums who had sources pretty much everywhere.
Don't miss it. So one of my takeaways from that is, why do you want to raise rates in December but then not raise rates again? I mean, it sort of seems like if you don't think the market can sustain the rates we're at now, what good does it do raising it one more time just for the hell of it and then keeping it paused? I mean, it sounds like basically he didn't want to really admit that the president was right when he was criticizing Jay Powell, who is the Federal Reserve Chair. Now, there's other reasons that I think that the president could have done a better job criticizing, because I think that the Federal Reserve does bear criticism, although my criticism would probably be much harsher and a little bit different than the president's. Now, Jim Cramer is a gold Goldman Sachs alum. And then here we have an article from Investopedia where it says Goldman sees 0% returns and highest bear market risk in 50 years. And I'm going to go back to, in just in a little bit, something that was called the Trump effect and why good news is bad news. This was a presentation that I originally made in January 2017, even before Trump was in office. And really everything I saw back then is exactly now coming to fruition. Yeah, and since we're in this rigged game where people have to understand that the very first dollar that was ever created, there was a bond that backed that dollar. Now, why that's important is, the root word of bond is bondage, and so you lend out the first dollar that was ever created. It was made up out of thin air. It never existed, but now we owe interest to that dollar. So at the end of year one, you lend out $1 in 1913. Now at the end of year one, we owe $1.04. There's no way to pay back $1.04 with $1, so we have to borrow another dollar, and it's a system that we can never get ourselves out from underneath, and eventually the system is going to end itself. Now, I don't have any insight in exactly when that day will be, but I knew that one of the major catalysts for this would be pretending that the rates could go up to begin with, and I'm sort of jumping ahead of myself a little bit, so going to go into a few more articles over here. We've got Bridgewater's Dalio. So Bridgewater is the largest hedge fund in the world, to my knowledge, and it says Fed rate hikes are hurting asset prices. And really, it's the whole reason when the Fed was doing these when they were doing quantitative easing, or aka money printing, what they were doing is they said they were doing this to raise asset prices. And now that they're doing the exact opposite of that, wouldn't that have the opposite effect? And that's been something that I've been harping on, over and over and over again. And it's just absolutely crazy how more people basically didn't realize this. And then Ray Dalio also goes on to say, in other words, because of that tax cut and the deficits, we'll have to sell a lot more bonds, and the United States itself can't absorb the quantity of bonds. So we're going to have to sell those bonds to other investors in other countries. Okay, well, who are the other countries? Well, typically, the largest investor was the Federal Reserve. Now they're actually the largest seller of the bonds. They're going to be selling $600 billion of bonds every year. Then we've got, after that, we've got the Chinese, who now were in a trade war with China, and they just dumped a whole bunch of treasuries just a few days ago. Then the third largest buyer, sometime second, is the Bank of Japan, one of the most indebted countries in the world. Look at Europe; they're all a big mess. We're gonna, last time I checked, the African nations weren't really super rich, or the South American nations weren't super rich. And do you think the Russians are to come buying our bonds? So who is going to buy these bonds? It's going to force the market to force the interest rates higher, whether the Fed likes it or not. The Fed only controls the interbank overnight lending rate. They don't actually control the longer term rates, but what they set at the Fed policy level and the amount of bonds they buy certainly distorts things and gives people false impressions of what's really going on, but they're not actually the end all be all when it comes to setting the longer rates, unless they're actually buying the bonds. And of course, if they're in there buying, taking trillions of dollars to buy up bonds, then of course that is going to have an impact. We've got Morgan Stanley coming out with a letter to their clients, and in 6 words, they said, "We are in a bear market." So, there you go. There you have it right there. We've got an article here from the Wall Street Journal talking about the FANG stocks, that's Facebook, Amazon, Apple, Netflix, and Google, that have lost close to $600 billion just since the beginning of October. We've got another article here where it's called The End of the Tax Cut Boost, and this is actually really crazy, where I'm trying to find the exact point in here, but it says since 2009, the reported earnings per share of corporations has increased by a total of 391%. So that's obviously a lot. Now, this is the sharpest post-recession rise in reported earnings per share in history. However, the increase in earnings did not come from a commensurate increase in revenue, which has only grown by a marginal 44% during the same period. This is an important point when you realize that only 11% of total earnings per share growth actually came from increased revenue. Now, why this is important is basically the only way that the market has been going up recently, or I guess since 2009, has been a lot of different accounting gimmicks. I already mentioned you had the Federal Reserve printing all this money, and then a lot of this money then went to corporations who were able to borrow the money at almost 0%, or in Europe, they sometimes borrowed at -%, aka they were paid money to borrow money, which is sort of crazy, and I can't even believe that even has been going on. And so all these people are really just fiddling while Rome burns, and don't even realize the basically the extent of what has actually been going on and how crazy of times that we've been living through. And when it comes to the federal, or when it comes to these earnings per share, a lot of the tax cut has basically went to these major Fortune 500 companies who use the tax cut to then buy back their own stock. So now they had less stock outstanding. Maybe they had the same earnings, but the earnings went up because now they have less stock outstanding. The CEOs have major financial incentives to do this because a lot of times they get paid, in some cases, $1 a year, but all their pay is predicated on stock options. So if they can do things to artificially increase their stock price over a short term, well, then what that does is that then they all of a sudden find themselves with, hey, I just got $50 million of options, because a lot of times it's like, you either hit this number or you get nothing. And so the CEOs are in many cases incentivized to do short-term actions, just be able to, boost their own bottom line, not necessarily the company's top line. But what is going on is that now that the interest rates have going higher, some of these companies were actually borrowing money to then buy back their own stock. You saw like companies like GE who borrowed tremendous amounts of money, and now all that money basically is up in smoke because it did absolutely nothing. So instead of investing in their companies, investing in research and development, investing in marketing or anything else, they decided that they would use that money to buy back their own stock. And what I'm going to do now is I'm going to pause, because this was a point that I wasn't going to bring up and just basically sort of just bringing this up off the cuff right now, but we're going to find out what the exact answer to that is just momentarily. So I found an article that was about a year old, and what it's saying is that GE actually spent $45 billion on buybacks, and they've got a $31 billion of what looks like a pension obligation. So instead of saying, hey, let's shore up our pension funds, or let's, actually invest into things that would actually help us out in the future, what we're going to do is we're going to basically rout out those evil hedge fund activists. And what we're going to do is we're going to buy back our own stocks and then increase our stock price, except the stock price is actually way down. So they actually spent more money. So let's say they're buying stock at $20 a share. And now, I should have looked this up before seeing what the actual price of GE stock is, but I'll do this on the fly right now. So GE stock, and see where that is going, because really it's $7.69. So they were buying back some of these stocks, I'm probably sure, into the 20s, certainly into the teens. And did it really do anything for them in the long term? No. Right now their stock price is less. It was all wasted money. That money should have been spent on actual research and development, trying to grow their company, but instead it was used for financial gimmicks. But they are not alone. Most of the companies, that is what they're doing, especially the big conglomerates. So eventually, this is when companies all of a sudden, there is a next recession, and all of a sudden, there's maybe the Fed can't go and print trillions of dollars, or if they do, then there's going to be some certainly huge inflation pressures, which could lead to a absolute perfect storm of having the stagflation, where the cost of goods are going up, but the basically incomes, everything else is staying stagnant. So you're actually losing purchasing power every year, which, that might be like the best case scenario of what's going on, because it certainly is precarious times that we are. Now, before I get into my Trump effect presentation, I wanted to just point out that Deutsche Bank hits record low on new worry over, I'm not sure how to pronounce this, the Danks roll, which AKA basically they're being accused of laundering over $100 billion of money, which is funny because as of right now, the cryptocurrency market has taken a huge bath, and people always say that, money launderers are going over to crypto, where, HSBC, or not, sorry, yeah, they're another one who've laundered money for the Sinaloa drug cartels and got caught doing that multiple times, but that was a sort of Freudian slip, didn't mean to actually say that. But Deutsche Bank in this instance has laundered more money than the entire crypto space combined, and yet, no one's worried about them. And they were one of the banks that when I had first left LPL, and not left LPL, when I left Waddell and Reed to go to LPL, I'd actually thought that they were going to be like the next Lehman. Again, it's like almost impossible to predict this, but if I was throwing darts at a dartboard and had to pick out who would be the next Lehman, they would certainly be my one of the top guesses. Although it's for what it's worth, no one can really guess this, and I didn't know that they were out here doing all this money laundering. So certainly that is just adding insult to injury. As I'm recording this right now, the Dow is down 550 points, and what I want to get into now is a presentation I had called the Trump effect and why good news is bad news. I'm going to just quickly gloss over this because this was originally made in January of 2017, and the entire premise was that all the good news, and the good right now is in quotation marks for those of you who are listening to the MP3, why good news is bad news. And the entire premise was that yes, Trump would do some good things for the economy, and compared to Obama, I think think that, that just the general optimism would probably end up raising some asset prices, but then that would then also then lead the Federal Reserve to not have the actual basically scapegoat or excuse to not raise rates anymore, which that would be the bad news. So it was called the Trump effect and why the good news is bad news. And right now we're looking at the Cape-Shiller Index. This was from 2017 and showed a PE, or the Cape ratio, of 28. I mean, I think today it's around like 31 or something like that. But long story short is the higher this number, the more overvalued stocks are. I mean, right now it's about as overvalued as, pretty much ever see it. And why that this is important is because when it's in this quintile, aka the most expensive quintile you can get, the forward 10-year returns only been 4%. So people right now are gambling a lot of their money, but you're doing that by taking on a ton of risk. And granted, I was a little bit wrong thinking that, hey, maybe this stuff would have happened a year ago, but I think it's better to be early than late on this. The strategy that we're running now, basically, if I'm wrong and the market keeps going up, we're going to win. And if the market goes down huge, we're going to win also as well. And this really kind of dovetails into the Goldman Sachs article that I was referencing, where it says Goldman sees 0% returns and the highest bear market risk they've ever had on their indicators in 50 years. And I think a lot of it has to do with this whole cyclically adjusted PE ratio, where, for the average person out there, that means nothing to you. And basically, the higher the number, the greater likelihood of being in recession. Now, another thing I want to point out is the dot plots. What the dot plots are is it's the Federal Reserve's guess of where they think interest rates will be on a basically like 1 year, 2 year, 3 year, and longer term time horizon. And why that's important is if you go back into 2000 and 2012, they thought that by 2015 we'd be at over 4% interest rates. Some people even thinking as high as 4.5%. You go back to 2004 estimates, and they say, by 2017 we'll be about 3.75-ish. Just kind of eyeballing this. You go back to 2016, it's a little bit less optimistic. They're probably a little bit over 3, probably about 3.25. Then you go to September 2018, and now they're saying that the longer run being, 2022, that we're probably looking at rates being, I'm kind of eyeballing this again, probably about 2.75%. And so it just goes to show you that all along, I thought they were full of crap. All along, I knew they couldn't raise rates. All along, I didn't think they'd even be able to even get to this point of being at 2%. But the entire market was predicated on, excuse my language, bullshit. The entire time was predicated on all this stuff of every other financial advisor, every other economist, every other person saying that I was absolutely nuts for saying the Federal Reserve could not pull this off, saying that I got in trouble when I was at Waddell & Reed for emailing one of my clients, saying that I thought the Fed was trapped between a rock and a hard place and there's no way they could ever unwind this. And they haven't even gotten to half of what they said they'd get to in 2015, what they estimated at 2012. And this is them. They're the ones who were in control of raising it, and they are off by over 100%. And here I am, as I have no control of what the Federal Reserve is doing. And how is it that I'm more right than they are? So it's absolutely crazy because they don't know what they're talking about. We've gotten halfway there, and look at the chaos that all this has has caused. This is from 2016 right now. What I'm showing is that the mean annual income it takes to buy a home, and this was from 2 years ago when I made this initially, but it was 64,800 when traditionally it's only been 45,000. Then we get into how it's taking more and more money to buy a home, except now with the interest rates, that is certainly another headwind going against it. And so this slide was made in 2017, right after Trump was elected, before he was even inaugurated, and it reads, tax reform is needed but will not be easy to pass. And even I didn't think that they would be as ballsy to make just a corporate tax return. I thought it was going to be more geared towards the middle class, but of course, all these guys that hate Donald Trump, they're the ones who got the major tax break when it comes to these big Fortune 500 companies. And believe me, I'm for basically no taxes at all. Not basically, I am for no taxes at all. All our money's being pissed away. The fact that the money is created out of thin air anyways, there's no reason to even have taxes to begin with. There's no reason to pay interest on the money that we borrowed to begin with, but it's all there as a tool of control and a tool of enslavement. I then go on to say people are putting way too much faith in the GOP that they will actually pass Trump's proposal. Bingo. I think that's been obviously that's the case. I put Republicans have been playing politics, and they'd rather have Obama policies and basically then take the blame for what's coming. And then I get into healthcare reform will help consumers, but it will take a while to be implemented. And elected Republicans controlling everything, and they couldn't even get rid of Obamacare. Talked about infrastructure is needed, but is only $1 trillion spread out over 10 years. So there's only so much that can go on. I then talk about potential trade wars and currency wars. And this is an important part, because I then go on to say the U.S. currently benefits by exchanging our debt for actual goods. How long will the rest of the world put up with this? Because the downside to this approach is jobs flowing out of America. So what's happening is we are giving IOUs, fake digital money, to China and Japan, and then they're giving us actual goods. So we get actual goods, and they get a piece of paper that's on a computer screen that is probably less real than even Bitcoin. And because at least Bitcoin took some energy to actually create that. And now what they're doing is they're trying to say that, we're getting the raw end of the deal, but we're actually getting real goods, and they're just getting pieces of paper. If anything, I think the people who are getting pieces of IOUs are the ones who are getting the raw end of the deal. Then we go on to the next slide, talking about demographics and how that's going to be a major headwind, as in 2008, most baby boomers, the oldest ones, were turning, I believe they were just turning 62. They weren't having to withdraw from their 401ks or IRAs, because a lot of them weren't planning on retiring until like 66 or 67. Well, now they're 72 because it's 10 years later, and now they're being forced to take money out of their retirement accounts. Trump and Mnuchin, who is the Treasury Secretary, also talked about having 50 and 100-year bonds. I said that's absolutely crazy, because even if the rates were 5%, then the interest would be over 5 times what it was at this writing, aka over $1 trillion. And that there's no way that would happen. And actually, what has happened is that Donald Trump, not only did he not increase the length of the bonds, he actually decreased the length of the bonds. And so, most of the bonds we're printing now are incredibly short-term in nature, let alone 50 and 100 years, because who the hell is going to buy a 50 and 100 year from the Federal Reserve? And then some of these charts are things that I've already mentioned on recent podcasts, so I'm not going to go back over these. But in any regards, this is all information that you're not seeing out there in mainstream media, certainly not seeing out there in the financial press. But it is very important, so I would highly recommend you guys go back, listen to the previous podcasts, especially episode 36, 37, 38. This is episode 39. I accidentally started off 38 saying it was 39, so don't be too confused by that. But if you could share this with a friend or family member and say, hey, especially if they're into, let's say they're a Ron Paul fan, or they're maybe against the government, or they don't trust the news, or they or they don't want to lose a bunch of money during the next downturn, because right now I believe we've got one of the best paths forward. One thing you can do, if you go to my website, you'll see there is a link for Riskalyze. So if you go to, let's say, episode 36 over here on the right hand side, it says, have you stress tested your portfolio lately? You can click on that. What it will do is we'll let you know exactly how much risk you can take on a scale of 0 to 100. I don't promote this very much. I should. And what I can do is I can actually then, and I'm willing to do this for my listeners, to actually see how much risk is in your portfolio. So, you might say, hey, I can only take on like a 50 risk, but you might have a 84 risk in your portfolio. And we can model out what it will look like in terms of, if 2008 were to happen again, what that downturn would look like. If rates were to go up 2%, what that would look like, what it would look like in a good market like 2013, or even last year, what that would look like, and then really set those expectations. But now that we have the put option strategies, really our clients are in the best of both worlds. They're being a lot less affected than everybody else right now, and there is a finite amount that they can possibly lose, whereas the average person out there, they've got about half their money camped out in bonds. That's going to do absolutely nothing. It's complete dead weight. And what I'm saying is take a little bit of that money, buy some of the what I'm calling insurance. So technically isn't insurance. It's 100% liquid from day one. And then obviously you should talk with your financial advisor first, and just don't do anything by yourself, because options are something that's very tricky. And if you don't know what you're doing, don't just Wikipedia or Investopedia and try doing it yourself. Talk to your own advisor, see what he says. If you're looking at trying to get into cryptocurrencies right now, I think is about as good a time as any. It's always, and you go back to 2009, and there was like this article, I forgot where it was from, maybe like Money Magazine. It shows, basically the economy holding on by basically like a piece of like dental floss that was a huge rope, and now is teetering on the edge of completely falling off a cliff. And it's in hindsight, that was the best time to possibly invest. Right now people think crypto's dead, which means it's probably one of the best times to invest. Now there could be other mitigating factors out there that could drive the price lower. I mean, I think there are some big scams that are still out there. There's probably many, many, many scams. Many of these ICOs have no business being in business, but there's going to be a lot of selling pressure on the crypto markets, because what happens is these companies that raised tens of millions of dollars, they raised it they raised it in Ethereum. Now Ethereum has crashed 90%, and now what they need to do is they're just trying to survive, so they have to sell the Ethereum that they have just to build up their working product, and it's creating a big stress. Or there's other some of these stable coins. There's one in particular that a lot of people think is a fraud, and I don't want to get myself in trouble or get sued. So I think a lot of people know who I'm talking about, and if you don't, come talk to your financial advisor, and odds are they'll have no idea either. So then come talk to me. And if one of these stable coins ends up being a massive fraud, then you could see that shake investor confidence. But all this is a blip in the radar. I think you're going to look back 10 years from now and say, oh man, I really wish I got into this Bitcoin when it was at $4,700 or whatever it's trading at right now. And we can do a small amount of your investment portfolio or your retirement portfolio into actual cryptocurrencies. I'm probably the only advisor in America that can actually do that for you. So so give us a call. You can get a hold of me, tim@innovativewealth.com. You can actually go and schedule on thelibertyadvisor.com. You can plug yourself right in, schedule. And I hope everyone has a great Thanksgiving, and thank you for watching, and talk to you guys later. Take care.